Hi traders, I'll be walking us through 5 perfect entry patterns in trading the foreign exchange market. These entry patterns are highly profitable when adopted in trading any form of foreign exchange market, and also these entry patterns are highly identifiable in every market. Trading tips. How you doing, traders? Welcome back to Boom and Crash Daily channel, BOOMCRASHGFX channel. We must appreciate the subscribers to the channel. You are the best, as you will ever remain the best. And if you are new to the channel, don't hesitate to click the red button, subscribe to the channel, turn on the post notification bell for you to receive notification anytime new video, trading tips, trading tricks, trading analysis will be shared with us on this channel. Going straight to the business of the day, talking about 5 perfect entry patterns in which all of us can actually learn and adopt in our trading activities, which actually buttress down in making profit in the market. Going straight to 5 perfect entry pattern in the market. Let's go.
Feel the end and it's near. The day of reckoning's here. The sound of deafening fear.
Taking us through the 5 perfect entry pattern in every forex market. Number 1 is the AOV entry pattern, and AOV simply refers to area of value. As a forex trader, you must have your area of value. And when we say area of value, what do we mean by area of value? Area of value is actually the price level at which most units of an asset we are actually traded during a specific time or a specific period of time. In short, talking about area of value, we are actually talking about our support and resistance. And what do we do at these particular levels? Talking about resistance, what do you do at resistance? Just sell. And what do you do at support? Just buy. So knowing your area of value, marking out your resistance and marking out your support, once you are able to mark out your resistance, you know what to do at that particular level. You sell. And once you are able to mark out your support, what do? You buy at the support levels. So basically, these are your areas of values. These are your entry points in the market. So going straight to the second entry pattern. The second entry pattern we are going to be looking into is called pullback entry pattern. And when we talk about pullback, what do we mean by pullback? As we all know that the price in the market actually moves in a concurrent way, alternating in between falling and rising, alternating in between bearish and bullish, and alternating in between selling and buying, which goes to say that the price in the market actually moves in a wavy form, which we call the price waves. We have the price moving in an impulsive wave and also moving in a correctional wave. So taking pullback as our entry strategy, we are looking for a situation whereby the market is making correction. So one thing we have to know is that we have to always identify the trend of the market, be it uptrend, be it downtrend. The idea is that you have to wait for the price to pull back in any trend you may plot out in the market, be it uptrend, be it downtrend. Once you see the market moving in a particular trend, what you should be waiting for is the pullback of the price in the market. This is where so many traders actually get it wrong. Taking position at some non-strategic entry, you probably think that you should take advantage of any trend you find in the market. You see the market going in an uptrend, you see the market is actually going high, then boom, you want to go into the market and start buying. No, that is totally wrong. What you have to do and what you have to plan out in the market is that you should wait patiently for the price to make a correction, for the price to pull back to a particular AOV, area of value in the market, which are the particular area of resistance or area of support. And when looking at pullback in the uptrend market, you are looking at the AOV for you to buy, looking at the support. As we can see on the chart, we having the AOV marked out, plot out by the trend line. We have the AOV, the support AOV, whereby the pullback in the market are actually directed towards and then making continuation of the trend. So pullback entry pattern is actually a counter trend movement of a certain market structure. And one thing is that so many traders actually blow their accounts, not because they were actually counter trading, but because they did not get good entry. If you want to trade a trend, you miss a particular entry at a certain AOV, or price actually possibly broke out of a particular channel which you have marked out and be watching, and it actually retakes, and then you have your highs on the market. What you have to do is for you to calmly wait for the market, ensure you identify a proper pullback and enter at a particular peak. If it is a downtrend market, ensure you make your entry at the peak. or high. And if it is an uptrend market, you ensure that you make your entry at the trough or what we call low. So talking about when pullback is actually complete in the market, there are some tools which we can actually adopt in identifying when pullback is actually complete. Tools like Fibonacci tools. We are going to be talking about that in another video for another day. So going on to the next entry pattern. Recap on our 5 entry pattern list. Number 1, we have the AOV, which is the area of value, talking about our resistance and support. Second on our list is the pullback entry, and number 3 is the MA indicator entry pattern. So looking into MA indicator entry pattern, and when we talk about MA simply means moving averages. We have different types of moving averages. We have the simple or arithmetic moving averages, and we have the exponential moving averages. We have the weighted moving averages. We have the triangular and the variable moving averages. So what we are going to be talking about particularly is on the exponential moving average, which we can simply call the EMA entry. EMA entry pattern, exponential moving average entry pattern. You can actually use other methods in moving averages. You can actually use the other moving averages, the simple averages, or called the arithmetic, the weighted averages, the variables, and so on. But here we'll be focusing on the EMA. So looking at this form of entry patterns, we are going to be looking at in two dimensions, in which we are going to be talking about the EMA confluence, and we are going to also be talking about the dynamic AOV in using this indicator entry pattern. So firstly, let's talk about the dynamic AOV entry pattern. As we all know, when we talk about AOV, we actually talking about the area of value. I'm talking about the area of value. Simply, we are talking about the resistance and support. So in looking at this dynamic AOV of this indicator, we are actually looking at the support and resistance which are supported by these moving averages, the exponential moving averages. Let's plot this indicator on a chart for us to know what I'm actually talking about. So let's plot our EMA on the chart, giving us that dynamic AOV in the market. So also we have the settings for the mobile phone displayed for us. So let's go for our indicator. What we do, we search for the EMA. Here we have it. We have the moving average exponential. We go to straight to our settings. So the length, what you do is the length using TradingView, you change to 30 on your mobile phone. Quickly, just period, you change on the period, you change it to 30. The source, you make it close. That's all for the mobile source, close. So our smoothing line, you change it to EMA, and our smoothing length, you change it to 30 as well. That's all. So this indicator actually gives us our dynamic AOV, and when we talk about AOV, the area of value, we are talking about the resistance and the support in the market. So as we have it on the chart, we see once the price touched this EMA, you can see the price actually respected this EMA and make the resistance and start falling. So also we have in this particular area, the market starts touching severally before, and thereafter we get and thereafter we could see breakout from here. So we see the price actually broke out of the EMA here. And what do we have? We have the retest, and the price started falling, making that particular place a resistance. Also we have it here, we have the resistance out of the EMA. We have the resistance, and when it comes to uptrend, we have it, as you can see, you can see we have it here, we have it here, we have it here. From here you can see the price actually broke out of this EMA, and thereafter you see went back, which gave a first breakout of the trend, and from the retest there you can make your entry. There you can make your entry and go along with the market trend. So that's for dynamic AOV. So the second part of this, which is the second division of this entry pattern, is the EMA confluence. Talking about the EMA confluence, this is actually a situation whereby two moving averages actually meet or crosses. So we've been making use of this form of EMA to pinpoint our entry. Once we get to see these two moving averages come together, crosses join, there we target for our entry. So let's go straight to the parameters of these confluence EMA. So at the corner of our screen, we can see the settings displayed for the mobile phone, and on our trading view, we are going to be inputting these two moving averages for us to see how these moving averages can give us entries in the market. So let's add up these two moving averages, the first averages. So we search for the EMA. Here we have it. We have the moving average exponential. Let's add up two. Okay, let's go straight to the settings. The first one, length, we have 150. The cells remain closed. The smoothing line, we change it to EMA, and the smoothing line, we change it to 150. And let's change the color to red. Color red, straight up. Done. So let's go for the second moving averages settings. The input, we're going to change this to 350. The cells close, and the smoothing line, we change it to EMA. The smoothing length also change it to 350. The color blue. Good. So what are we looking at? Don't forget, we are talking about the EMA confluence. I'm talking about EMA confluence. We are basically looking at situation whereby these two moving averages actually join or crosses, and in that scenario, once we can find these two moving average crosses in the market, this will show us the trend in which the market is on. Then we vividly know that this is what we are going to be doing in the market, giving us an entry either for bearish selling or either for buying. So let's backtest and see the reaction. Okay, we have the two moving averages which actually crossed at this point. So at this point, we can see the prices actually going in an uptrend, and in this particular point, it's telling us our major entry will be for buy, going on the buy. So truth be told, we cannot actually rely totally on these moving averages indicators, because actually indicators actually lag. So all we are going to do is couple with our previous entry pattern. Putting all this entry pattern together will actually definitely give us an edge. Then we can confidently go for an entry in the market. So as we have it, as for this entry pattern, moving averages entry pattern, talking about this confluence entry pattern, like I said earlier on, situation whereby or scenario whereby you see these two moving averages crosses or join together. Once you see this happening and see the price reacting above these two moving averages coming together, all your entry, all your focus in the market will be for a bullish move. And in a situation whereby you see the price above the crossing of these moving averages, all your focus in the market coupled with your order analysis, all your focus will be for bearish selling move in the market. So having said that, let's go straight to the next entry pattern in the market.
The scene so clear, I feel the end and it's near. The day of reckoning's here, the sound of deafening fear.
The next up on our list is candlestick entry pattern. So talking about this kind of entry pattern, there's a lot to this because this actually entails a lot that can't be talked about in this particular video. So I'm only going to be pointing out some major candlestick pattern in which we can easily identify in the market and give us that entry we are looking for in the market as some strategic AOV in the market. So a candlestick is actually a way of displaying information about price movement in the market. So talking about candlestick pattern are actually used to predict the future direction of a price movement. So pointing out these candlestick patterns in the market, we have a lot of them. I'll be preparing another video which we are going to be talking about going to like 16 to 20 candlestick patterns which we can find in the market and which will actually benefit every one of us. So here right now I'm going to be talking about just 5 candlestick pattern which we can easily identify in the market, then take our entry in the market. So the first one I'm going to be talking about is the hammer candlesticks. Talking about the hammer candlestick pattern. The hammer candlestick pattern is actually formed of a short body with a long lower wick and is found at the bottom of a downward trend. So sorry guys, I forgot to talk about the components of candlestick and the things to look out for when studying candlestick. Majorly the components of candlestick are just the body, the wick, and the color. So generally we all know, and for those that don't know, the color for a bearish candle in the market is red, and generally the color for a bullish candle in the market is green, as it is vividly displayed on the screen for all of us. So I was talking about hammer. Hammer is kind of candlestick that actually tell us that yes, there's selling pressure during the day in the market, and eventually there's a strong buying momentum pressure that actually drove the price back up, giving us a bullish move in the market. So example of this is what is plotted for us on the screen. We have the hammer in a series of strategic level AOV in the market, telling us and what you see this kind of candlestick, you already know that the buyers are coming into play, gaining momentum and pushing the price upward in the market. So we have it in different strategic levels in the market. As you can see, the price started pushing back. So the other candlestick pattern, which kind of the opposite of this hammer, is the hanging man. So what is hanging man? The hanging man is the bearish equivalent of that of hammer, totally the same shape, totally the same way, but the difference of this is that this actually happens at the end of an uptrend, giving us that sellers are coming into play, gaining momentum, and they are what, pushing the price down. Example of this is what we have here. This is an hanging man candlestick pattern, in which once we identify this in our strategic AOV level in the market, this is telling us that the sellers are coming into place, are in action, and they are ready to push the price down. So going straight to the next candlestick pattern. So the next candlestick pattern in which I'm going to be talking about is the inverse hammer. So talking about the inverse hammer, the inverse hammer is actually a bullish pattern. So the difference in between the inverse hammer and the hammer is that the upper wick is actually long while the lower wick is short. Remember, when we talk about hammer, the hammer has a short body with a long lower wick, but when it comes to this inverse hammer actually have a long upper wick and a lower wick which is actually short. So what's the work of this inverse hammer? As I said earlier on, this inverse hammer is actually a bullish pattern. It gives us the notification for buying pressure in the market. So basically, this inverse hammer actually suggests that buyers will soon take control of the market. So the example of the inverse hammer is what we have on our screen here. As you can see, it actually plays out what is actually preaching for us, telling us that yes, the buyers are actually coming into the market to take control. So the last but not the least candlestick pattern which I'm going to be talking about is the bullish and bearish engulfing candle in the market. We have seen a lot of candlestick which I can't actually talk about in this video. We have the doji, we have the morning star, we have the evening stars, we have the three black crowns, we have the dark cloud covered, we have the spinning top, we have the falling training methods, we have the rising training methods. We have a lot of candlestick pattern in which I'm going to make a different video for that, which actually entails every candlestick pattern in which traders must actually be acquainted, familiarize themselves with in the market. So going straight to this bullish engulfing candle and the bearish engulfing candle. So talking about, firstly, let's talk about the bullish engulfing candle. And when we talk about the bullish engulfing candle, what are we talking about? The bullish engulfing candlestick pattern is actually formed of two candlesticks. So the first candle is a red small candle, in which the next up, the second candle, will bring out a large green bullish candle engulf, which is actually telling us that when we have a smaller candle in the market in our AOV level, and the next up candlestick that actually erupts out of the zone is a big candle. This candle overshadow the previous candle. That is a good notification telling us that bullish momentum is in place. So this typical example of what bullish engulfing candle is actually talking about is we have the small bearish candlestick, and the next up candlestick we find coming out from the market is an engulfing large candle which actually overshadowed the previous the small candle in the market. This gives us the buying pressure coming in place in the market. So quickly going to bearish engulfing candle. So the bearish engulfing candle is actually the vice versa of this bullish engulfing candle, the other way around of this bullish engulfing candle. So talking about the bearish engulfing candlestick pattern, this actually occurs at the end of an uptrend, same way in which the bullish engulfing candle actually occurred at the end of a downtrend movement in the market. So just like we have this more bearish candle for the bullish engulfing candle to come out, giving us the buying pressure in the market, so also we have the small bullish candle at the end of this uptrend movement in the market, and the next up candlestick in which we find coming out of the market is a large candle, bearish candle, telling us that there is selling pressure coming into the market. What kind of entry that is giving us? That is actually giving us a bearish entry, a selling entry. So a typical example of this bearish engulfing candle is what we have here. As we have it, we have this more bullish candle stick, next up candle stick in which we find coming out of the market is the engulfing bearish candle. So just like man to man, when you have a tiny man going against an empty man, you already know that the empty man is actually going to overpower and do anyhow with the small man, as the case may be. So applicable in the market, the small candle in the market. So next up we have the big one coming into place. That's telling us that the big one is in charge and it's time for them to take control of the market. Once we have this in our front in the market, this is actually a good entry pattern, good notification for a entry in the market, be bearish, be bullish. So that's for candlestick entry pattern. So the last but not the least entry pattern we are going to be talking about is that of breakout and retest entry pattern. So basically, when you talk about breakout, what actually are we talking about? Breakout is actually a situation whereby price escape a channel, a price channel, or escape a particular AOV area of value, be support and resistance, and thereafter turn back or come back to this point of escape, giving us that there is a break in structure. Possibly you may have it in mind, or you might have this question that how possibly can you identify a breakout in the market? Very simple. All you need to do is firstly identify the trend in the market and be able to identify the area of values in the market, the resistance level and the support level in the market, and also be able to identify certain chart pattern in the market. Making use of your trend lines, most traders actually adopt this kind of entry patterns. They call it strategy as well, breakout and retest strategy, whereby they identify a particular chart pattern, a particular price channel in the market, a particular area of value support and resistance, and all they are waiting for is a breakout of this structure with a good confirmation that truly this is a breakout happening. Because there are times that first breakout actually happens in a situation whereby you see the price telling you that there's a breakout of a particular channel, and thereafter you see the price actually coming back. But once you have this good confirmation that this is a breakout, all you need to do is just await a retest of that AOV and you go for the move accordingly. So as we have it on the screen, I haven't identified our resistance, we identify our breakout. Prices has been touching the zones for quite long, and thereafter we get the breakout of the zone, and you can basically see that the market actually came back to the point of escape there, and there's a retest, made a retest, and price start moving down. So you can also identify series of other channel, and mostly this actually happens in the market because the price we are talking about actually move in a wavy form and move in a particular price channel. Once you are able to identify all the channel price charts in the market, all you need is just await the breakout of those chart pattern channel and wait for the retest, then go for it. As we can see as well here, we have a touch of this, the movement of the price, that the trend line resistance and touch the trend line support. What do we have here? We have our breakout here, our breakout at this point, and what do we get here? We get the retest of this particular channel, and another confirmation we get is this particular support, which as well was broken out and retested, making that support a resistance. And what do we have? We have the price falling down big time. So also we have it here. Haven't identified our strategic highs and low in the market. I haven't identified this price channel in the market. As you can see, we have the price from the trend line resistance moving back to the trend line resistance, falling back to the trend line support, and the next thing we discover here, the price got to the trend line resistance, reacted like it's going to fall back. It's going to fall back to this trend line support, but eventually what we got a breakout. So all we need to do is just expect and be waiting for the retest of the trend line resistance in making it a trend line support for a bullish move. And what do we get here? We have it coming back to the trend line resistance, and what do we have? We have the price move up. You get whatever you want to get in the market. These are actually definitely ramparts in the market. So once you are able to identify your high, identify the highs in the market, identify the lows, just plot out the price channel in the market. So once you are able to plot this out, await the breakouts of the channel of whatever chart you've plot out, await the breakouts and confirm that truly it is a breakout, and thereafter what you should be expecting out of this is the retest. And once you have this, you can see the price actually break out of the channel, then you get our retest, and what do we have? We have a boom going up and up. So this kind of pattern is actually rampant in the market. Most trader can, even every trader actually adopt this in their trading skill sets, in their trading strategy. I also adopt this kind of entry pattern. So believe me, this kind of entry pattern will definitely help you out. All you just need to do is to able to identify the trend, identify the channel in the market, identify the AOV, the resistance and support, identify every form of chart pattern in the market. And once you are able to identify this, what you need to do is just to be patient enough to wait for the breakout. And once you get the breakout, not that when you see the market has actually broken out of the channel, go in. No, you don't go in straight away. What you need to do is just wait patiently for the market to retest the channel, and then it is fine for you to place your entry at that particular point and enjoy the ride. So that's that for breakout and retest entry pattern. That's it guys for the video. I believe you all enjoy and learn one or two things from that video, and I also hope that the video actually bring additional value to your trading skill set. So if you enjoyed the video, kindly give the video a thumbs up and don't forget to subscribe to the channel. Quick list to these 5 entry patterns which we have discussed about. First one, we talk about the AOV, the area of value, and also we talk about the pullback entry. Also we talk about the EMA, the exponential moving averages, and also we talked about the candlestick entry pattern, and last but not the least, which is the breakout and retest entry pattern. So you know the drill guys, a must to appreciate the subscribers to the channel. You are the best and you will ever remain the best. And if you are new to the channel, don't hesitate to click the red button, subscribe to the channel, turn on the post notification bell for you not to miss out on every video, trading tips, trading tricks, trading analysis that will be shared with us. Until next time, I come away. Bye.